The conversation around bonds continues to confuse us, Abe. So let's work to clarify, all right?
Sure.
This is Abe Abich, founder of Abich Financial Services, financial advisor, retirement planner. I'm Heather Branch, here to ask Abe some of the questions. I feel like more and more, the further we get into the digital age, the faster the headlines come at us, the more that's what we should focus our podcast conversations on. Here's the headline I read this week, Abe. Can you please explain what we're reading, what we're saying?
True. That's true.
So the conversation around bonds, we've had lots of conversations, you and I, on this podcast, on your radio program, because what we've seen happen with bonds over the past 5 or 6 years has been, interesting, depending on your perspective. Unfortunate for some people that were heavily invested in bonds because of interest rates. I'm going to let you dive into the nitty-gritty of that. You're the financial advisor.
Sure.
The headline here is personal finance guru Tony Robbins has apparently said, you need bonds in your portfolio. Tony Robbins says, and I quote, he calls bonds the foundation of a mind-blowing portfolio that works in all economic climates. So let's break this down a little bit. Right. And another thing also, we always say, don't take blanket advice. Nothing works all the time, everywhere, period, end of story.
Right.
So first problem.
Yeah. So no, I like Tony Robbins a lot. Someone that I respect. Finance guru, maybe, but he's been known to interview some of the biggest financial gurus in the world. And then put the book, his books together, which have been popular, like Money Master the Game and other books. Where he's interviewing some of the most successful financial investors in the world. Not everyone, not everything someone says is going to be true or accurate, or you're going to believe in it. The fact that he says that bonds are going to work in all economic climates. Well, how about 2022 when bond funds were down, -11 to -15%? Specifically, one fund that I bring up as an example to clients and prospective clients is BND. BND, B as in boy, N as in Nancy, D as in dog, with Vanguard. Vanguard's bond ETF, BND. Well, in 2022, it had a -15% return. -15. Ouch. Stocks were down 15 to 20. Bond funds were down 13, 15, -11 and -15. So there was nowhere to hide in 2022. And that's because interest rates rose in 2022 7 times, 4 times in 2023. And bonds and interest rates have an inverse seesaw relationship. So when interest rates rise, bond values on bond funds fall. And so that bond fund that was otherwise safe in the past, otherwise making low single digit returns, 3 to 5%, pretty commonly in the past, was down -15%. Someone that put $100,000 in that fund on January 1st of 2022 was down to $85K. So that's not safe to us, and that's not safe to our clients, and that's not working in all economic climates. Now, when interest rates go down, bond values rise, and that can be attractive. You can have some appreciation on those bond funds that you own, but still the yields can be pretty low. The average annual return and yield of that bond fund since inception, the last 18 years in a row, is just over 3%. Well, we're barely keeping up with inflation. And then we can actually lose money and lose principal if rates rise. So it's not that bonds are never in our portfolio. It's not that we hate bonds and are just totally allergic to them. We're going to have some short-term treasury bonds usually in our portfolios. But it doesn't mean they're always going to work, and you need to understand the pros and cons and the ins and outs of them and how they may benefit you or potentially hurt you. So, Tony Robbins was saying that bonds are more stable investments. Yes, this is true during turbulent economic times. Why? They're not as risky as an aggressive. It's a debt instrument versus an equity instrument, where stocks you're an owner, here you're a loaner or you're loaning money, you're it's part of the fixed income portfolio versus the growth side of the portfolio. So naturally, they're not going to be as volatile as stocks. When global markets are shaky, those nearing retirement, trying to keep their nest eggs intact, maybe you should consider them. Bondholders can also expect to receive interest on a regularly basis, while retirees need income on a regularly basis. And then he was saying, once a person, I think this is actually really key.
Yeah.
Once a person, this is from the article, once a person is within 5 years of retirement, they need to de-risk their portfolio to some extent. A large downturn in the equity markets immediately preceding retirement can have devastating effects on one's individual standard of living in retirement. I totally agree. And that could affect someone for the rest of their life. Meaning, you retire this year, Heather, and you've got $5 million saved, and heading into the back half of this year and early next year, let's just say the markets are down. They're not only down, let's say they're down the next 3 years in a row, and they're down 10%, down 15%, down 20%. And you're like, hey, boy, you told me I can retire and I have $5 million. Number one, you don't have $5 million anymore.
Right.
Number two, you're not working anymore. Number three, you've got to dip into your portfolio for income while the markets are down.
Right.
That can have a huge negative effect. That's that sequence risk we talk about a lot on this podcast and on our radio shows and everything. Yeah. While there are a lot of good points that Tony made, there are also just some things that you need to be aware of. And so what we don't build at Abich are these cookie cutter 60-40, 70-30 portfolios that are just stocks and bonds, because you can get that anywhere.
Right.
That's going to be more part of an accumulation plan, helping someone reach that retirement goal number. Once someone gets to that retirement goal number, which is usually around 60, 65, they're getting closer to being able to take Social Security, being able to take a pension, being able to hop on Medicare. Mm-hmm. Then they're realizing, well, when can I retire? I want to retire. I'm getting tired. I want to spend more time with my grandkids. I want to travel. I don't like the commutes anymore. I don't like the people that I work with anymore. Whatever the reason is, people are wondering when they can retire. And that's exactly when the plan should start shifting. Okay. From maybe the cookie cutter, more traditional stock bond combo to maybe stocks, bonds, annuities, structured notes, other instruments that are principal protected, buffered, offering more protection, focusing on protection, preservation, distributions at the same time with the growth, right? Okay. Leading up to retirement, the sole focus is growth. At the point of retirement, heading into those early distribution years especially, we need to be focused on other things.
Well, and so many people for decades have turned to bonds as a place of safety for their savings. Mm-hmm. They become more bond heavy as they get closer to retirement. That's another thing that we brought up, is the idea of TDFs, target date funds, in our 401ks. Right. They move you more into bond. Traditionally, right. TDF is set up where it moves you more into bonds and out of stocks as you get closer to your retirement goal line. So for somebody who's listening to this podcast is like, okay, yeah, I agree with you, Abe. Bonds have not performed that well. Let's talk about, again, I always like to give action items. What can people do? So seeking bond alternatives. Yeah. What are our options there then?
Yeah. So we have
and adding safety. What can we do?
Right. We have a few key bond alternatives that we turn to as a financial firm. In no particular order, you have certain types of annuities and you have certain types of structured notes. So annuities are offered through insurance companies and structured notes are offered through banks. Okay. You could look at a fixed rate annuity. You could look at a fixed indexed annuity. Fixed rate and fixed index are typically principal protected. You typically can't lose any money when the markets are going backwards. That also means a more limited return compared to returns in the equity markets, the stock and ETF index fund markets.
Yep.
What could one expect on a fixed rate annuity or a fixed index annuity? Well, historical returns on fixed index annuities going back the last 30 years are usually in between 4% and 6%. Well, if you think about what you could make on a bond fund and you look back at historical rates, you're probably in that same range, maybe between 3 and 6, depending on the bond duration, the bond type, the quality, and all of that stuff.
Okay.
If you start getting them into that 5 to 6 range on bond funds, you're probably taking on more risk, maybe going out longer in duration, which is length, and probably taking on more risk. I mentioned the BND bond fund with Vanguard. We use a lot of Vanguard funds, but not that BND fund. Its average annual return is 3. So 3 is not a big hurdle. Like right now, where interest rates are now, you can probably make close to 4% on a CD. You can probably make 4 or a little bit more on a fixed rate annuity. Why wouldn't someone consider something like that over a bond fund if they have the potential to make more and maybe even guaranteed with more protection on the downside? Yeah, that should be something we should look at. Fixed indexed annuities been around for about 30 years. In 1995, they were born. Historical returns or yields, usually in between 4 to 6, total downside protection, growth potential linked to an index, not interest rates. Take the S&P 500. Maybe there's a company that says, hey, Heather, you can earn up to 6 or 7%, or you can earn 30 or 40% of the upside of that index without the down, right? So what does that turn into? Probably somewhere in between 4, 5, 6% yields. Okay. So what if it's a little bit higher than a bond fund? What if it's the same darn return over a lifetime as a bond fund with less risk and more safety on the down? That's absolutely something we should be looking at. Now, annuities have their pros and cons too, just like bond funds.
Everything has a pros and cons, yes. Everything's got a
so we get into that with our clients and prospective clients to truly make sure they understand what they're getting into. Yeah. What are the costs, fees, risks, pros and cons? Find something that's in their best interest. You can also look at structured notes. Some of these structured notes are buffered, meaning that a client can only lose money in a buffered structured note if the indexes like the S&P, NASDAQ, Russell, Dow drop below a certain amount, like -20 is a common buffer. And if the indexes don't drop down -20 or more, the client doesn't lose anything, whereas they would be losing money in the equity markets on the equity side of their portfolio. The stock side of their portfolio. Mm-hmm. Certain structured notes offer guarantees. Certain structured notes offer guaranteed coupon rates and things like that. Again, with structured notes, not perfect. There's a time commitment to them. You want to understand the pros and cons, but there are definitely bond alternatives that we can look to at the point of retirement, maybe a few years before, a few years into. You don't have to stick to the old same old cookie cutter combination of stocks and bonds. While that combination has worked in the past, every year is not going to work. And as we head into retirement, we need to think differently. We need to think outside the box a little bit and think about ways to be creative to make sure we're putting the best plan together for us that's going to last the next 30 years.
Thinking outside the box, thinking creatively. She can't speak the words creatively. But also thinking about things that work for you individually in your plan. And that's another thing that you're constantly emphasizing, Abe, is you talk about don't take blanket advice. If Tony Robbins says bonds work in all economic circumstances for everybody, it's like, well, let's take a step back and analyze how it might work for you and in your plan and in your savings and for the goals that you have for the years ahead. So obviously Abe and his team working every single day on these customized plans. They can do the same for you, help you get some information and knowledge about how you might be able to better position yourself, bond alternatives, ways to add layers of safety. TheRetirementKey.com is where to start that conversation. We also have links posted in the show notes. Also, a great resource to begin educating yourself on different kinds of ideas, strategies, ways to add layers of protection in your plan is by reading Abe's book, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement, is a book you published. Gosh, was it a year ago that we had the book launch party?
Almost. That's right.
I can't believe it. So you wrote this book. It's a quick read, just a little over 100 pages, not even 100 pages. You can read it in a couple hours on a Saturday or Sunday afternoon. And it's a great way to, again, get some initial thought starting ideas as far as building your plan for retirement, because so many of us, Abe, we've saved, we have a nest egg, but what we have is a savings account. We don't have a plan for retirement. And that's what you're spelling out for us in this book, how to take that money and now make it a plan, right?
Absolutely. Absolutely. We've worked our entire lives to get to the point of retirement. This book will help prospective clients especially understand everything they need to know, or a lot of what they need to know in that successful transition from their working career into retirement. So many new things that are going to come down the pike for you, so many new decision points that you're going to have that you did not have when you were 30, 40, and 50 that you need to be aware of as you head into full retirement.
Got it. Well, Abe wants to get you a copy of this book. He has published this book all about everything Abe and the team you guys do at Abich Financial is working to empower people with information about their savings and their retirement. So we've got links posted in the show notes. You can buy the book on Amazon. If you come in for an initial review, we'll give you a complimentary copy. I believe we've got a digital download. You can download the book for free. And again, Abe just wants to share this information with you and work to empower you with education and information about ways you can better position yourself for the second phase of your financial life, also known as your retirement. So we've got links posted in the show notes. You can click there to learn more about how to get your copy of the book, or again, visit us at theretirementkey.com.